The Dropbox one was interesting because the company was a unicorn and had waited quite a while to go public. So there was a lot of pent up demand and excitement. It was a bit slow last year and more headlines about it versus when we took NetSuite public. But they were both really good experiences and great opportunity to learn as a finance professional from both.
Welcome back to the Growth Under Pressure podcast. I'm your host, Eric Josovitz. Today, I'm joined by CFO Eileen Tobias. Eileen, thanks for joining us today.
Thanks for having me, Eric. Nice to see you.
Of course. So, Eileen, tell me about your background. How did you get to finance and being a CFO?
Yeah, great question. Candidly, I sort of lucked into a career in finance. I went to college at the University of Texas at Austin, and I was a liberal arts honors graduate. And I was in the which is an interdisciplinary liberal arts honors program. And while I was in school, I figured, well, I should probably take a few business classes just to make my degree a little more practical and applicable for the post-college world. And so I ended up joining Pricewaterhouse in Houston after I graduated and did public accounting for a few years, and then had the opportunity to move to the San Francisco Bay Area in the mid-90s. And ever since then have worked in finance in technology companies. And I was fortunate to work for companies like Hewlett-Packard, Brocade Communications, NetSuite, Dropbox, and most recently as a full-time CFO, Komodo Health. And I had the good fortune to work for some really great companies, be mentored by some fantastic CFOs, and kept progressing in my career. And like I said, so I didn't initially start out with the idea in mind that I would build a career in finance, but started out in it, and here I am.
That's amazing. Well, that's such an interesting time when, the dot-com era was getting started. You're in Silicon Valley in the 90s. I'm sure you're just, completely intrigued by all the changes with AI and all the stuff that's happening now. What is it like to go from finance in the 90s in tech to, now with AI?
Yeah, great question. I think what we're going through right now, it reminds me in many ways of what we went through in the early 2000s when I first started at NetSuite. And that was, I joined in 2005. SaaS had been around for a few years, or the cloud had been around for a few years, but it was still certainly not widely adopted and just taken for granted the way it is, right? That was a real revolution in technology and computing. And so when I think now about the rapid pace of change and what's happening with AI, I think it's a really fascinating and interesting time for everybody. And I think there's a lot of great opportunity for finance. I'm not sure that we've necessarily all figured out yet how we'll use AI, but I think it's an exciting time for the function.
Yeah, it's definitely a wild ride right now. But, kind of just speaking about where you started, liberal arts, being in Texas, and then, getting into finance. How'd you make that transition? Was there anything that you learned in college that really brought you into finance, into the office of the CFO, or was it more just, hands-on experience working with a few companies, working with Hewlett Packard and these others that kind of catapulted you into the finance world?
I think it was a combination. So, like I said, I took some business classes, and University of Texas has a fantastic business program. So that certainly helped build a good foundation for finance. But I'm sure you may have seen this in your career too. A lot of what you learn in school is very theoretical, and it's not until you really get out into the working world and start doing accounting work, doing finance work, getting mentored by folks who are more experienced than you are. So I would say it's a combination. Yeah.
For sure. And how do you break into the office of the CFO and get to be an executive, in a finance world and such a competitive, fast-paced environment, especially with Silicon Valley? I know a lot of people are just lined up to get in the door. How do you break into that and, have the success that you've had?
Yeah, I mean, my path to the CFO role was through FP&A. So my initial start to my career was in public accounting, and then when I left public accounting, I worked in cost accounting, and I was also a general accounting manager. But from my last role at Brocade, and then moving on to NetSuite and the company since then, my career was really focused on FP&A, and that was a great path. I think there was a time, and it's certainly there are many paths to the office of the CFO. You can go through the controllership, through investment banking, through IR, et cetera. But I think that over the past couple of decades, there's been a real push for more FP&A expertise and more strategic finance thinking from the office of the CFO. And so that, I think, really helped me um, to make it to the CFO seat. I think I was also really fortunate to we had two CFOs during my tenure, my 12 years when I was at NetSuite, and then I worked for another great CFO at Dropbox. And so I really got that benefit of long sustained relationships where I could get a lot of mentoring and take that mentoring and that experience with me to the CFO seat. Yeah.
I couldn't agree more, especially for my career. I started in public accounting as well. Not a big four, but a local regional firm. And then I just jumped into a head of finance role for a startup similar to what you were doing,
Mm-hmm.
which was ultimately a senior financial analyst position. Started to get, my feet wet in different areas, then got molded under a CFO. And so I think it was a similar path. Mine was less corporate, and I feel
Mm-hmm.
like FP&A is definitely that foot in the door if you're on the accounting side or any other field to get to that CFO role. Would you agree?
I think so. Yeah. I think you could certainly get there through those other paths, but there's a lot of value placed on FP&A's knowledge and expertise these days when folks are evaluating candidates for the CFO seat.
Yeah, yeah, it's definitely not a one size fits all. I'm seeing a lot of these Fortune 500 companies that will hire their COO or someone else that's already internal that knows the company as their CFO. But yeah, it's such an interesting path that you've had in your career
Mm-hmm.
from NetSuite to Dropbox to Komodo Health. Talk to me a little bit about, you know, taking companies public, acquisition. What was that one where you kind of were like, wow, this is a big deal?
Yeah, great question. So I've had the good fortune and luck to work on two SaaS IPOs. So I was part of the finance leadership team that took NetSuite public in 2007, and then Dropbox in 2018. They were very different experiences. NetSuite was an earlier stage company. We went public right before the recession, the 2008 recession, um, and so we were really getting our legs under us, excuse me, and really maturing as an organization while we were in the public markets. Excuse me. Compare and contrast that with Dropbox. We were already north of $1 billion in revenue as a private company, and had a lot more scale and actually sophisticated processes inside the company. We did have to shift to obviously being accountable to public shareholders, but it was just it was two very different processes to take companies public at those different stages. Um, the Dropbox one was interesting because the company had waited was a unicorn and had waited quite a while to go public, so there was a lot of pent up demand and excitement for that one. So it was a bit splashier, and I think more headlines about it versus when we took NetSuite public. But they were both really good experiences, and great opportunity to learn as a finance professional from both.
And what about
Um,
Komodo Health? Talk to us a little bit about um, the acquisition with Komodo Health.
sure. So there wasn't an acquisition with Komodo Health. Komodo Health is a later stage health tech startup, and so I was there from 2020 to 2023, and great ride in terms of really fantastic. ARR growth and opportunity. We did a couple of acquisitions and some few rounds of fundraising while I was there. So it was a really great opportunity as a CFO to, to really learn and mature in the seat.
Hmm.
But yeah, so company is still a standalone company and
Okay.
still private. Yep,
But they were valued in the billions, right?
they
Three,
were.
two,
Yeah,
3 billion.
yes, another um, unicorn health tech SaaS company. Yeah,
Just profitable. So it's funny how you could take one public, you can sell, or you could just continue to, keep profits and make the shareholders happy,
that's right.
keep your culture. I think there's a lot to say about that.
Yeah.
Is there did you notice anything lost with the Dropbox and NetSuite IPOs that maybe changed the company?
Yeah, that's a good question. So, that transformation from private company to public company, it's pretty significant, right? I mean, when you're a private company, you're accountable to your whatever portfolio of shareholders you have. When you enter the public markets, now you're accountable to the public markets, and so much broader portfolio investors. You're also can be much more in the media, and much more, unfortunately, for better or for worse, you're much more tied to that quarterly cycle, right, when you're a public company. And so it's a real challenge as a leader at a public company to balance short term success with longer term strategy. I'm sure, as when you're at a private company and you're not on the path to entering the public markets, you have a bit more latitude in terms of being focused on the long term and less on the short term.
Hmm. Yeah, I've
Yeah,
always wanted to stay in small businesses and stay away from, you know, uh, corporate life, enterprise type businesses, but it's not to say that the culture is much different. I think it's all people. You're still working with people.
that's right.
Um, it's just a lot, it's high. I think at scale you have a lot more foundation, right? And security to lean on. I think in this early stage startup environment, it's just high growth. You don't know what tomorrow looks like.
That's
That's why
right.
runway is a KPI for small businesses because you need to calculate how many months you have left, and then decide if you're going to raise again. So I think that gives us a lot of idea of IPO versus just high growth companies. Is there anything
Hmm.
else that you'd share about the behind the scenes of, you know, taking a company public? What goes on in order to prep for that?
Yeah, I mean, it's a really big undertaking, right? There are a few things that you have to really think about. So one, like we just talked about, it's that accountability to public markets. Are you and the rest of the leadership team and the board, is everybody ready, for that spotlight and that entree into the public markets? That's one. Um, you have to have, of course, all the things that get you to that decision point around product market fit, acceptance by the market. Do you have good financial fundamentals? All of that has to be there. But ideally, when you're taking a company public, you're going to be in it for the long haul as a C-suite and a board, right? And so I think you need to really know that you've not that you can predict everything with certainty, but that you have a sustained business that's going to be there in the public market for a long time is something. And then the last is with, you mentioned people. So you really need to get the entire employee base behind this idea of that transformation from private to public, because you're going to be operating under, different different rhythms, different quarterly cadence, different annual cadence, more scrutiny. You have to ride the ups and downs of the whims of the stock market, and there are things that you have to do from a governance perspective as a public company that are not negotiable and that you may not be as focused on if you're a private company. So it's a big undertaking, and I think a lot of companies can be very focused on getting to the day where you're ringing the bell on the stock exchange, which is a whole body of work. But that's really just a one-time event. After that, you have to be ready for that. that sustained marathon, if you will, of running a company in the public markets for the foreseeable long term.
Yeah, and there's also some confidentiality that comes with it where you can't share too much, or any little thing that you share could sway the market up or down, and you have
That's right.
insider trading, right? Like that's a big aspect of it, isn't it? And everyone in the company has to be behind that privacy aspect as well.
That's right. There's a lot of training that goes on with the employee base, and in the run up to a public offering, and then after that, you do ongoing training. But absolutely, you don't want to get anybody into a situation of inadvertently doing something that violates insider trading rules. Um, so yeah, that's a great point.
Well, that's great. That gives us a lot to build on. Give us a little bit on today, what you're working on these days. And we work together at Adapt CFO, and our clients rave about you, and would love to just hear more on what you're doing these days.
Yeah, thanks. Yeah, I'm really enjoying working with you and your clients at Adapt CFO. Past couple years, I've sort of shifted my focus from full time operator role to part time. I'm really enjoying advising a portfolio of several earlier stage companies. I think it's really fun to draw on my experiences at some of the larger companies that I mentioned earlier, and help founders, plant the seeds now for a good financial foundation so that they can move their company forward, whether it's ultimately an IPO someday, whether it's selling the company, whether it's acquiring other companies. But, I really believe in making that investment in a solid financial function and processes as early as you can. I think it really pays dividends later.
I want to touch on that one aspect of helping companies get to that IPO stage. Is there and I know we just talked about it a ton, but is there a identifier where like this company can go public, or this is a good revenue benchmark to go off of to take a company public?
I don't know that we can boil it down to just one single marker, but I think there's a combination of things. Certainly, you need to get to scale, right? You need to get to, and especially in this day and age, I think you have to get to at least a couple hundred million in revenue um, to be taken seriously about entering the public markets. And by the way, I'm going to speak here mostly about what I know about software and SaaS companies going
Hmm.
public. I'm sure there are different metrics depending on if you're in hardware or other industries, but you need to show that you've achieved that scale with a couple hundred million in revenue. Um, I'm sure you've heard of talk of the rule of 40 or the rule of 50, which is the combination of your revenue growth and profitability. And so
Hmm.
these days, you can't just enter the public market with a high growth. I mean, you will get highly valued on revenue, but investors and public investors want to see profitability as well, right? So companies have to either be on that path of profitability or show that they're very close to it, I think, to be taken seriously for entering the public markets these days.
Do the
Yeah.
other KPIs matter? The other SaaS KPIs like CAC and LTV and payback period and retention, do they also matter? Thinking of,
I
acquisition.
I think they do. I mean, certainly, I think your revenue growth, your gross margin, your net margin are really important. LTV to CAC is also important. And if you think about it, with retention, those feed into those other metrics, right? You're not going to have the
Hmm.
great revenue growth and the other margin numbers if you don't have healthy retention and LTV to CAC metrics. But you're right; those are important as well. And you also have to think through: are you a consumer business or a enterprise? B2B or B2C? But yeah, certainly retention is going to be another thing that investors are going to want to see, healthy retention metrics before you enter the public markets.
That's awesome.
Yeah.
Okay, well, that definitely gives us a ton. Anything else that you're working on these days? Yeah, I know you have a handful of clients that you work on. Maybe just quickly talk about the approach for startups, early stage businesses versus the later stage scaled, unicorns that are now public. and just the key differences other than, runway and burning cash.
Yeah, yeah. I think what's. I mean, and you've obviously worked with a lot of early stage companies as well. So setting aside cash and runway, because that's obviously really important. I think it's interesting to see revenue. Sorry, early stage companies are very very focused on revenue for obvious reasons, right? Like they want to get as many customers as they can. They want to gain share and book those deals. And I think early stage companies are often less focused on building processes around that and just let's just go get that deal, right? We'll think about the contracting process later or the go-to-market motion later or the metrics of how we measure the business later, right? And so it's interesting to see as companies mature, the focus can shift or become more nuanced. It's not just simply about getting revenue, but it's being able to do it in more of a, for lack of a better way to say it, a rinse and repeat kind of a way. And so I think it's fascinating to watch companies evolve as they go through those different stages. But like I was saying a few moments ago, I think when companies can still focus even just a little bit as they mature and grow on good processes, whether it's in sales ops, in HR, in finance, in legal. I think that it really helps later as they are thinking about an exit or just how to frankly, have a well run company. The better the processes are that you have, I think that leads to really good success.
Which is a lot of times the opposite of what founders, CEOs are doing at the early stages. They're focused on revenue,
That's
or
right.
user growth if revenue is not the
Mm-hmm.
main focus. And
That's
then
right.
accounting, finance, and operations is kind of just pushed to the side. But you're right, the ones that do really pour into finance and accounting in the early stage, of course, we're drinking our own juice. This is this is
That's
our world.
right. Yeah,
But it does seem that just laying that foundation in the early stages does reap benefits in, long term.
I think so. I think otherwise, what happens is if you really don't pay attention to it, you end up, and let's say you don't spend a lot of time focusing on those operations and processes, but are really experiencing a lot of fantastic growth. And then suddenly it's like, well, we want to go do another round of fundraising, or we want to take the company public, or we are being evaluated, for M&A by a larger company. If you don't have your processes and your financials in good order, it just makes those other things more costly and the processes get drawn out to get to an exit, right?
Yeah. And you
Or if
may
you're
not
trying to
get the valuation.
articulate, that's right. You may not get the valuation you're looking for. It might take longer to get through due diligence because you have you have messy records or you don't have solid metrics. I think another thing that companies sometimes do that I would caution them against is, and you've probably seen this, is that sometimes companies will start with a metric set and they don't really like how those metrics are working, and so they will switch to a different definition of either ARR or retention or gross margins or something like that. And of course, companies evolve, so it's not a simplistic thing where you just set up this one handful of KPIs at the beginning and never touch them. But I think if you are seeing results in KPIs that are not favorable, I think you have to really ask yourself, is it because this metric isn't relevant to my business? Or is it that this metric or these metrics are showing that the business isn't doing as well as we would like? And what can we do about it? And so I would advise folks to just really be thoughtful about when do you abandon a metric or change a metric or change the calculation. Make sure you're doing those things for the right reasons.
I'm smiling because it reminds me of my first head of finance role with a SaaS company after a Series A. And I was kind of like the first head of finance, and we looked at the KPIs. LTV was a specific one that I'm thinking about where we had like 4 or 5 different versions of LTV. We
Mm-hmm.
and we had to show the investors, and it was like, let's show the investors LTV with 9 months of retention and 18 months of retention instead of just the true LTV with the actual retention percentage. It's like
Mm-hmm.
So that's such a great point because, yeah, founders are creative. Founders and CEOs specifically are creative. So, but you're right, you need to stay focused and look to improve those metrics, not try to run away from them.
Hmm. Absolutely, absolutely. So, yeah.
Great. Great. Well, we always ask our guests, what was that growth under pressure moment for you in your career? If you do have one, I think everyone does. Um, we'll have to stop the podcast if if you if anyone doesn't, we'll have to stop recording. But you know what was that time like for you? If you had a dark moment or a cash flow scare, if you can think of one specifically.
Hmm. Well, I've had a long career, so I can think of several. Let's see. I guess I'll share a couple. I mean, certainly, when I think about NetSuite's story, and it's just a function really of timing. I mean, we didn't do this on purpose, but entering the public markets um, as a new, fairly young company, newly public, fairly young company that's still maturing in a great recession time period was not really, um, you know, the best time to be doing that. But we were public, we had to move forward with that, and so we had, a number of quarters where we weren't really growing that quickly. Sorry, before IPO, we had enjoyed a period of really rapid growth, and then the recession hit, and we went through a period of pretty high churn. It was not product related; it was just more. A lot of our customers were really suffering during the recession,
Mhm.
so we had to go through 6, 8 quarters of just sort of treading water and not really not growing in the way that we had, and those are pretty tough times, especially as a finance leader. So I'd say it took a lot of resilience and just belief that we had the right fundamentals, and that when we got through that period of recession, that we would return to growth, and we did. We had 5 years in a row of 30% or more growth after that before selling the company to Oracle. So those are pretty dark times. And I would say I think anybody who has worked at in finance at any company has to face a cash flow crisis, right? Where you're realizing we really need to go raise, or we need to pull back on spend, or really get creative about how we extend runway. So um, definitely have.
That's great. That's great.
Yeah.
Well, yeah, I've never had to deal with that type of um, issue, from a public company facing, having 6 to 8 quarters of, down. Of course, with NetSuite, I don't know if it's the Cinderella story is the right word, but they really picked back up, sold to Oracle, and now
Yeah.
one of the, you know, biggest names in, enterprise, ERP systems for finance. And really what ERP is, it's just an accounting platform that's connected to multiple different data sources to pull together clean financials, just QuickBooks on steroids, if you will.
Yeah, yeah, yeah. We were lucky. I mean, we were fortunately not really down in those periods. It was just more that we were just sort of holding and not really growing in the way that the market wanted us to, compared to
I see.
our. But when you're in a high growth company and then you sort of and growth levels out, that does feel like a dark time. I don't mean to be flippant, but like we weren't necessarily contracting; we just weren't growing. And in theory, in a SaaS company, you should never really be in that situation.
hmm And I'm sure you're,
Yeah.
you were in the news. It was from high growth, celebrating
Hmm.
wins to being in the
Just kind of
news,
holding.
public facing,
Yeah,
people not happy with the
that's right.
performance.
Treading water. Yeah. So, but really good learning experience. I mean, I think there that for anybody who's worked in business for any length of time, you're going to see that cyclicality of boom and bust time, recession and great times, and especially as finance professionals, we have to have that. have that resilience and the thick skin and be able to deliver both good and bad news and have clear heads and know that you know these cycles always happen, but in general we should be able to emerge from it. But we're often the ones who are partnering with other executives or other leaders across the company to get through those tougher times. And so you have to keep your head on your shoulders, right? And help your partners get through it.
And stay in the game, not quit.
Yeah,
And other
that's
than
right.
resilience and having thick skin, is it just preserving cash and just being really lean with operations? How do you go from high growth to steady, stable, call it flatline, um, and not, obviously still just kind of staying stable? Is it preserving cash? Are there other methods?
I think one is preserving cash. I mean, if a company's at a stage where literally cash flow isn't an issue, but let's say margins are an issue, right? So you got to figure out ways to control spend. Um, I think that one thing I've learned in my career that I would share is that I think even in the best of times, you can get distracted and not think of doing this, but we finance leaders should always have a rainy day plan, right? Even if your CEO, your board doesn't want to hear it, I think it's just a good thought exercise to run some just a couple of different scenarios versus your current operating plan. What if cash runs out, or sorry, what if we're starting to see that we're getting tight on cash? What if revenue growth slows? How are we going to maintain margins, right? How do you make sure that if there are changing business circumstances that you have a plan, or at least have thought about a plan about what would happen? Because often that those changes happen very rapidly and you have to react very quickly. And so if you've already sort of thought, well, these are some of the levers in the model that we can pull, I think that that is a great thing for finance leaders to do.
Yeah, when you become a larger company, you have some scale. Scenario planning is such a big aspect of that. With COVID,
Mm-hmm.
a lot of people saw that you need that rainy day fund, or you need a line of credit that you can fall back on, or a scenario where it's unfortunately, and it's tough to say this, but a skeleton crew, right? Like
Mm-hmm.
how can we remain open with just a small team, and maybe it's furloughing people, which it's like how long does that last, or do we need to let people go and let them and stop trying to drag them along and just let them go to their next chapter? But that's like, of course, that's worst case scenario. That's dark
Mm-hmm.
moments.
That's dark
Um,
moments for sure.
but you do have to have all those different scenarios on good, bad, really ugly,
Mm-hmm.
so you can prepare for the worst.
That's right. And and if times are really, if you're in high growth times, no one really wants to talk about the rainy days. But I think it's a good exercise for finance leaders, not to spend a ton of time on it, but really think about it, because as we've all seen, there are those business cycles, and having those worst case scenario plans there, um, I think are a good thing to do.
Yeah, and also the
Yeah,
upside scenarios as well. Like,
that's
hey, if
right.
we're beating our goals, we can pour more into marketing and sales and grow even faster, if faster, and fuel the growth and have more
Absolutely.
compounding.
Absolutely. Yeah. Whenever I run a planning process, I always like to have a parking lot list of investments that you'd say, okay, well, it's not funded in the current operating plan. If we see that we're overachieving on the top line, and we're underspending somewhere else, let's have that list that we can periodically revisit and figure out ways to wisely invest.
That's so cool. Well, thanks for sharing that. I want to get your opinion on finance tools that you're using these days. And maybe it's for small businesses, maybe it's for people out there that are just getting started and want to know, what's the low hanging fruit for a startup. But across the board, you're not going to recommend NetSuite to someone that just raised $100,000. But
That's
what are a
right.
couple key tools at the different stages that you'd recommend?
Yeah, great question. I mean, it's fascinating because this is an area where there is. I'm just amazed at how much innovation there is in the finance tech stack. There's just always a group who's saying that there's something different or new that we can do, right? And of course, the established players that are there that have been there for a long time. But what's exciting is for founders who are out there who want to start a company and have just raised, in your example, $100,000. I mean, today you can sign up for uh, QuickBooks and Stripe and entry level CRM products, and a handful of different SaaS products that you don't even have to talk to a human. You can just go on the website and with your credit card, set up, basically replicate um, a lower level, more slimmed down ERP. I think that's just fascinating, and companies can just get started very quickly and not have to invest a lot of capital and resources in systems at the beginning. And then, to your point, as you continue to evolve and at different stages, you may move from your QuickBooks to NetSuite or another mid market uh, ERP solution, and then there are lots of different point solutions that sit around those products. But I think it's a really interesting time to be a finance professional. There are just so many innovations and lots of different packages that are out there now.
Yeah, and you're using AI as well, correct? I know we talked about ChatGPT as one of them.
Yeah, I have to admit, I've used ChatGPT a fair amount. I have not yet used many of the AI tools that are specifically pointed towards finance. But I've tried to stay on top of what some of those tools, what they're doing, what they're trying to solve. And I think that um, I mean, look, there's a ton of opportunity for automation in the finance space. Um,
Well,
it's
there's so
just,
many out there.
yeah,
And
yeah.
QuickBooks, NetSuite, they're all putting AI into their platforms.
Hmm.
They've been using, like OCR technology to recognize, bills that need to be entered. It just
Hmm.
pulls the different line items off the bills and enters it without you having to type it out. But QuickBooks Online used to be just like this basic tool that people wouldn't use because it was QuickBooks Desktop, and a lot of people that are old, businesses that have been around, they need to transition this mindset of, hey, you know what, we have to have a desktop, a server, and
That's
and
right.
to and like get into
Yeah,
this world of cloud-based um, computing and SaaS technology.
yeah,
Well,
absolutely. Yeah.
great. Well, I want to learn a little bit about where you started. I feel like all successful people have some kind of background that got them to where they are today. Maybe talk to me a little bit about your childhood and things that your parents did that is different than someone else that wasn't as successful as you.
Wow, that's a great question.
No pressure.
No pressure, really. um, let's see. Um, I think I guess maybe one thing about me that I've had since I was a child was, I've always just been a really curious person. I've always loved reading ever since I was a kid, and I always, when I was in school, I really liked all the subjects. I wasn't really like, oh, I just I hate math and I like English, or vice versa. And so I think I've tried to carry that trait into my professional life as well. And in the different companies where I've worked, really try to do more than just be a finance person that's just understanding the numbers. Understand the business, understand the opportunities and challenges that my business partners face, whether they're sales leaders or engineering leaders, et cetera, um, and just and foster that sense of curiosity with the people who are on my team as well.
That's
I don't know
really
if that's
good.
answering your question, but yeah,
It
keep in mind.
does. No, it
Yeah.
completely does. It's kind of just like be creative and
Hmm.
read and learn and show that you're capable of doing the role, not just show up and there's like a fake it till you make it point, but then you still
Hmm.
got to make it. It's not just fake it forever. It's fake it till you
That's
make it.
right.
And when, you
That's
know,
right. That's right.
that's really good. And I want to just ask you about the role of in the relationship between the CEO and the CFO. From your experience, what really makes a good CEO? Because I know you've worked with a ton. When you're looking at these high growth, successful CEOs, what are those qualities that they have in them and that just make people want to work closer to them?
Yeah, when I think about the all the different tech CEOs who I've worked with, I would say the common thread among all of them that has been the number one driver of success is vision, right? That vision coupled with just that vision and passion and belief that they as individuals along with their companies are the ones doing the best at whatever it is they're doing, right? I think that
They
that's
just
that's yeah, that they just believe that this idea that they want to help customers solve is the whatever company that they're building is the best one to do it, and they're the best one to lead the company doing that. I think that would be the trait that I have seen among all the CEOs I've worked with, but especially the ones who have been really successful. I would say that's a standout trait.
I would agree. It's that
Yeah.
grandiose vision, this mentality that, yeah, they're going to have the best product or service and
Hmm.
um, they're going to push and either dominate their competitors or just go right past them without even seeing. Um, which it's funny because I do think a lot of early stage companies have this mentality that like I can't tell my competitors about what I'm working on because they're gonna crush me. When the reality
Hmm.
is, if you just keep your head down, focused on your vision, you're gonna speed right past them eventually.
Hmm.
That's great. Well, let's
Yeah.
just close real quick with three rapid fire questions. The first one, what's that one metric you check every single week without fail, or the one KPI that you advise your clients to look at every week?
Yeah, that's a great question. I think I'm probably going to be unoriginal and say cash, especially for early stage companies. And then and then if you don't want it to be, too trite, I guess, or too unoriginal, I would probably follow that up with whatever you see as the health of the business. Either check ARR or revenue, or you also throw out their user growth. I think if you're looking at cash and you're looking whatever top line metric, those are the things that I would look at and I would advise other leaders to look at.
That's great. And
Yeah.
name one book, podcast, or speech for me that you recommend to most founders under pressure.
Ooh, founders under pressure. I read the book Atomic Habits a couple of years ago, and I really like that book. I don't know if you've read it, but
Yeah,
it's a great book about uh, taking small bites in terms of building long-standing habits for success. And I found it to just be a really approachable, common sense book. So I really recommend that one.
yeah. Actually, one of our early stage clients, I think they were maybe third or fourth client we had. She let me borrow it, and yeah, it's so good. And he
Yeah.
also has a podcast. Maybe not a podcast, but he's been on podcasts before, and he has some resources online.
Mm-hmm.
So I would absolutely recommend that one. Complete this
Yeah.
sentence for me. A CFO under pressure should always.
Do the right thing.
That's really good. That's so good. Eileen, this was a ton of fun. I always enjoy chatting with you. Thanks again for joining me.
Yeah. Thank you very much. I enjoyed it as well and look forward to catching up again soon.
Sounds good. Thanks, Eileen.
All right. Thank you. Bye.
That's it for today's episode of Growth Under Pressure. I'm Eric Josovitz from Adapt CFO, and I hope these insights help you tackle your biggest scaling challenges. If you want to help other founders find the show, give us a quick follow or a share. Thanks for listening, and I hope to catch you next time.